In the grand theater of modern capitalism, the audience cheers as the numbers rise. Profits soar, stock prices climb. Executives boast of endless growth, but behind the curtain, a quiet illusion unfolds, one not built on innovation or productivity, but on repurchasing one's own success. This is the story of how corporations learn to manufacture value out of thin air. The corporate structure was born to pool capital, share risk, and reward investors. It was an idea that fueled the Industrial Revolution, ships, railroads, and steel. But as centuries passed, purpose gave way to perception. Corporations discovered that the market didn't reward production, it rewarded appearance. When the New York Stock Exchange rose in the 19th century, it didn't just trade shares, it traded expectations. Every ticker movement reflected hope, fear, and speculation. Soon, companies learned that stock prices could shape reality more than production ever could. By the 1920s, stock manipulation was rampant. Executives inflated prices, creating false confidence before selling out. It was a gilded age of wealth built on air, and it ended in collapse. The Great Depression would force the world to question what corporate value truly meant. In 1934, the U.S. Securities and Exchange Commission banned stock buybacks as a form of market manipulation. For decades, corporations were restrained. They had to earn value the hard way through innovation, expansion, and productivity. But this restraint wouldn't last. Then came deregulation. In 1982, Rule 10b-18 quietly reopened the gates. Corporations could once again buy their own shares, legally, safely, and invisibly. It was the rebirth of the illusion, wrapped in legality and profit. Stock options became the new incentive. Executives now earned wealth when share prices rose, not when productivity improved. Suddenly, stock buybacks weren't just corporate policy, they were personal gain. A feedback loop began. Companies used profits to buy stock, prices rose, bonuses grew, and the illusion strengthened. Investors adored it. Buybacks signaled confidence. Analysts praised them as efficient capital allocation. Soon, financial media joined the chorus, turning a manipulation tool into a symbol of prudence. What was once deception had become doctrine. A buyback reduces the number of shares, raising earnings per share without improving the company itself. It's arithmetic magic, creating value without creating wealth. To the market, it looks like growth. To the real economy, it's nothing but rearranged smoke. By the late 1990s, buybacks were everywhere. Corporations spent billions on their own shares, even as wages stagnated and innovation slowed. It was no longer a tool, it was the core of corporate strategy. The illusion had become the system itself. By the dawn of the 21st century, growth had become a religion. Quarterly earnings were the scripture. Stock prices were faith. Executives preached expansion, but their temples were built on borrowed gold. The sacred ritual of the modern market was no longer innovation or labor. It was the buyback. As manufacturing faded, finance rose. Corporations realized they could earn more by manipulating money than by building things. Factories turned into spreadsheets. Innovation gave way to balance sheet alchemy. Financialization wasn't just policy, it was transformation. Economists once imagined corporations as communities of workers, investors, and consumers. But by the 1980s and 1990s, one philosophy dominated: maximize shareholder value. In this creed, every dollar must serve investors, even at the expense of innovation or workers. Stock buybacks became the ultimate act of devotion. Corporations began borrowing heavily, not to expand, but to repurchase. Debt became a weapon of illusion. As interest rates fell, buybacks rose. Borrowed money inflated the market's pulse, feeding an economy that looked strong but stood on air. Between 2010 and 2020, over 50% of all S&P 500 earnings were spent on buybacks, not research, not wages, not new markets. Half of all corporate profit was used to purchase perception. Every rising index point was a reflection of capital consumption, not creation. In a world obsessed with short-term profit, long-term vision vanished. Investment in research and innovation declined. Startups were acquired and dismantled. The machinery of capitalism turned inward, devouring its own future to feed the present. Wages stagnated. Job security faded. Productivity soared, but workers saw little reward. Every dollar that once built factories now built executive bonuses. The economy grew richer, but people did not. The illusion of prosperity masked a deepening divide. Economists praised buybacks as efficient. They said it signaled companies had no better investment than themselves. But true efficiency is not self-cannibalization, it's creation. The buyback era mistook extraction for excellence. Behind every buyback was a symphony of bankers, analysts, and fund managers. They sold the narrative, managed the debt, and pocketed the fees. The illusion was profitable for all, except the public. Wall Street had built a perpetual motion machine that ran on illusion and confidence. As buybacks lifted, share prices, executive pay rose. As executive pay rose, more buybacks were approved. A perfect circle, self-reinforcing, unstoppable, and unsustainable. The market had become its own myth, believing in the illusion it created. In the medieval world, Alchemists sought to turn base metals into gold. In the modern world, corporations found a way to do it with numbers. Debt, once a burden, became the philosopher's stone of finance, transmuting liability into wealth. The new alchemists wore suits instead of robes, but their magic was the same: the illusion of creation. Here's how it works. The company borrows money, often at low interest rates, and uses that borrowed cash to buy back its own stock. The number of shares shrinks, profits per share rise, and the market cheers. The company looks stronger, even though its balance sheet is weaker. Debt, disguised as value. After the 2008 financial crisis, central banks flooded markets with liquidity. Interest rates hovered near zero. Corporations saw an opportunity: borrow endlessly, buy back endlessly. The cost of illusion had never been cheaper. Buybacks reduce shares, so even flat profits look like growth. Analysts see rising earnings per share, not the mountain of debt beneath. The public sees success, the media repeats it, and confidence grows. The illusion becomes indistinguishable from truth. But every spell has a cost. Debt accumulates quietly, compounding in the shadows. Interest payments eat into future profits. Eventually, the illusion must feed on itself, borrowing more to sustain the glow. Even as debt grew, ratings agencies often looked the other way. Financial engineering disguised risk as stability. As long as stock prices climbed, few questioned the cost. The illusion of safety became as valuable as safety itself. Central banks became the quiet enablers of the buyback age. By keeping rates low and liquidity high, they fed the corporate addiction. The more markets wavered, the more money flowed, protecting the illusion. A silent alliance between public power and private gain. To the casual eye, buybacks look benign, just returning value to shareholders. But beneath the language lies a form of accounting theater. Profits vanish from productive use and reappear as executive wealth. Numbers are painted, not earned. Executives claim buybacks show faith in their company, but confidence isn't conviction, it's choreography. By raising share prices, they create the illusion of belief. And in turn, investors believe in the illusion. Faith feeds itself until reality interrupts. By the late 2010s, corporate America was addicted. Even companies losing money borrowed billions for buybacks. The illusion of endless growth had become the lifeblood of the market. The alchemists had succeeded. They turned debt into gold. But as history teaches, every empire built on illusion eventually meets reality. Every empire built on illusion eventually faces the truth. By the early 2020s, the cracks began to show. Corporate debt soared to record highs, innovation stagnated, and wages remained flat. The illusion of prosperity had turned into dependency, a structure too fragile to move, yet too large to fail. For all the billions spent on buybacks, productivity barely grew. Companies weren't investing in factories, technology, or workers. They were investing in their own reflection. The economy looked richer, but it wasn't stronger. It was the illusion of wealth without the foundation of growth. Research budgets shrank as stock-based compensation ballooned. Shareholder satisfaction replaced long-term vision. When the pursuit of the next quarter replaces the pursuit of the next century, innovation withers quietly, almost politely. The wealth created by buybacks never reached the workers who built the products. Instead, it flowed upward from labor to capital, from effort to equity. For every dollar returned to shareholders, a wage was frozen, a pension cut, a dream delayed. The illusion of fairness faded. As the illusion deepened, so did the maze. Companies refinanced old debt with new, rolled over loans, and hid leverage through subsidiaries. Balance sheets became labyrinths designed not to inform, but to obscure. Even analysts lost the map. Executives, armed with buybacks and bonuses, became the new aristocracy. Their fortunes grew even as productivity stalled. It wasn't performance that rewarded them, it was the manipulation of perception. The illusion had become self-sustaining, even celebrated. As the illusion grew, markets became addicted. Each quarter demanded more buybacks, more stimulus, more support. Without constant financial feeding, stock prices faltered. An economy designed to appear strong had become dependent on the very illusion it created. Then came the global pandemic. As the real economy froze, buybacks suddenly stopped and markets trembled. It was the first moment in years where the illusion vanished. Without manipulation, the system revealed its fragility. Governments rushed to save the system, not just the people, but the illusion itself. Bailouts, stimulus checks, and zero rates revived the machine. Corporations resumed buybacks, stronger than before. The illusion didn't die. It evolved. Every illusion demands a price. Years of buybacks built a generation of fragile corporations, rich in valuation, poor in resilience. When the next crisis comes, they will again look to borrow, to buy back, to appear strong. The empire endures, not through progress, but through repetition. History whispers, even the brightest gold fades when forged from illusion. The illusion of prosperity did not lift all boats, it divided them. While executives and shareholders soared, workers and savers were left behind. The age of buybacks became an age of separation between capital and labor. Illusion and reality, privilege and participation. Stock buybacks rewarded those who already owned wealth. Executives with options, investors with portfolios, they became the modern nobility, heirs, not of bloodlines, but of balance sheets. For the first time in history, ownership itself became the ultimate weapon. As wealth concentrated, the middle class eroded. Home ownership stalled, savings dwindled, and wages stagnated. Buybacks created stock price inflation, not economic mobility. The illusion of growth became a wall between classes, invisible, but impenetrable. Once, innovation came from competition. Now, with buybacks dominating, capital sought predictability. Smaller firms were acquired or crushed. Ideas became financial assets, not revolutions. The creative spirit of capitalism dimmed, replaced by a hunger for control. The illusion wasn't confined to America. Global markets mimicked the buyback model, from Europe to Asia. As nations competed for capital, they too embraced short-termism. The world economy became a hall of mirrors, each reflection reinforcing the illusion of endless prosperity. Investors loved buybacks until they didn't. The illusion inflated their portfolios, but also hollowed the real economy. When markets stumbled, they realized their gains were paper-thin, built on the same air that once felt like fortune. For the worker, the illusion became resentment. Promises of shared success never arrived. As corporate profits hit records, their wages did not. The distance between effort and reward became too wide to ignore. And in that gap, disillusionment grew. Governments faced a paradox: condemn buybacks and risk collapsing the illusion that sustained the markets, embrace them, and deepen inequality. So they did what many empires do: they managed perception, not reality. Young generations entered an economy of shadows where the cost of education, housing, and healthcare soared. While corporations hoarded cash to manipulate stock prices, for them the market was not a ladder, it was a locked gate, guarded by those who owned the illusion. But history moves in cycles. Inequality breeds unrest. Illusion breeds awakening. A growing movement began to question the legitimacy of the buyback era. Could a system built on illusion be reformed, or must it fall for something new to rise? The empire's fate hung in balance. Every illusion, no matter how powerful, has an expiration date. As the 2020s deepened, the weight of debt, inequality, and stagnation began to break the illusion's spell. Stock prices wobbled. Buyback announcements slowed. The golden empire began to shimmer and fracture. Investors started asking a dangerous question: what happens when the music stops? For years, returns were built on momentum, not fundamentals. The awakening was slow, but inevitable. When belief faltered, value had to be rediscovered the hard way. Regulators and economists began to speak out. Laws were proposed to curb buybacks, tie executive pay to long-term growth, and prioritize reinvestment. For the first time in decades, the corporate elite felt the walls closing in, not with violence, but with questions. Then came inflation, the invisible tax of illusion. When money flooded markets for years without creating real productivity, prices rose and purchasing power fell. The illusion's cost was now visible to all. Even the richest couldn't ignore the tremors beneath the gold. Public sentiment shifted. Once awed by record stock markets, citizens began to question who the prosperity served. Protests, policy debates, and viral campaigns called out the artificial nature of corporate success. The illusion, once admired, became despised. Under pressure, some corporations changed course. They began investing in workers, research, and sustainability again. Shareholder meetings turned from victory parades into moments of confession. The word buyback became synonymous with greed, not growth. Slowly a new idea began to emerge: that true value isn't created by scarcity or illusion, but by productivity, innovation, and trust. Investors began rewarding those who built, not those who borrowed. The market, like a repentant empire, rediscovered purpose. History is cyclical. The same forces that inflated ancient empires, debt, illusion, and pride, also destroyed them. The corporate era of buybacks was no different. Its story became another chapter in humanity's endless struggle between truth and appearance. Out of the ashes of illusion came a quiet movement toward purpose-driven capitalism. Companies began to rediscover the value of people, ideas, and impact. Not every firm changed, but enough did to remind the world: finance can build, not just extract. The age of buybacks will be remembered not for its wealth, but for its warning. That illusion can be as powerful as gold, and just as corrupting. In the end, every empire built on mirages must face the mirror. And when the reflection fades, what remains is truth, fragile, enduring, and real.